during the down cycle, it was very tough for us to do anything but flip, and that was challenging as well. But what comes after that is the best period for real estate investors there is, and that is the trough and up.
Welcome to the Good Stewards Podcast, the only podcast dedicated to seasoned real estate investors who want to maximize the cash flow potential in their business. We are buy and hold investors with 1,000+ properties and markets across the U.S. who bring an insider's view into the nitty-gritty details of real estate investing. If you're looking to develop the mindset, teams, and systems that can dramatically build your real estate business and net worth, you're in the right place.
Welcome to this episode of the Good Stewards Podcast. I'm Ryan Dossie.
I'm Amanda Perkins.
And I'm Bill Sirius.
And I'm Andrew Sirius. Welcome, ladies and gentlemen, to the Good Stewards Podcast. We're here to discuss the current economic situation as a whole, where the market's going, and what to do in a down market or a market that is trending down as a real estate investor. For more, please follow us at thegoodstewards.com. Plenty of content. Subscribe to our podcast as well. But today we want to discuss the ins and outs of basically our economic situation and what's in store. We don't have a crystal ball, but we have certain reasons to think certain things are going to be happening. And I mean, eventually we will be right. We are currently in the longest expansion in American history. I think in July, we set the record, and now we are kind of in uncharted territory. Now, this hasn't been a crazy expansion. It's been a rather slow expansion. It's mostly been sort of 1 to 3% growth per year, but all good things, or at least all, maybe this one isn't good, all decent or relatively mediocre things will eventually come to an end.
You can only kick the can down the road so far.
Yeah. Yes. And I mean, as we are recording this in September of 2019. The Fed just dropped interest rates. There are places in this where interest rates are going below zero, which doesn't seem to make any sense. I'm not sure why you wouldn't just stuff it in your mattress at that point. That was supposed to be sort of a bad joke. Now it actually might make sense for I don't see what the point of investing in a -1%, -2% interest rate is. But if you want to lend at -2% interest, please reach out to us.
Yeah, we're here.
Absolutely willing
people in Europe are already experiencing negative interest. So in other words, when they take their money to the bank, they actually have to pay for the privilege of having it in the bank. That hasn't come to the United States yet, but that is...
I mean, given the returns on your average CD, 0.4% or 0.3%,
it's close.
There isn't much. I mean, if you take inflation into account, it is a negative. I mean, inflation even now is probably 2-3%. That is, you are making a negative return by holding on to your cash. So all the more reason to invest it, but invest it carefully, especially as we're moving towards an economy that probably will be going into recession within the next 18 months. Probably. Of course, there again, with economic predictions, that you have to be very, very careful. I remember seeing this, it was interesting. I think Christopher Nolan was giving an interview about his movie Interstellar, and they're talking about how physicists could be like, exactly where an atom would be in any given time. Whereas at the exact same time, economists can't even figure out like what the stock market will be tomorrow. So,
one of the things though, too, is it's sort of happening while you're living in it, and it's not happening in every single market. And so like living through it the last time, it was hard to know when it was happening to you. You were hearing about, things happening everywhere. And so it was until you were faced with it, we were more on the tail end of it, I feel like, than some people were. So that's what it felt like to me.
Absolutely. But I think the big key here is don't take anything we're going to say here as gospel or anything like that. There is no such thing as a sure thing with regards to predictions. Wall Street, stock speculators are paid a fortune to get it better than average 10% of the time. So and even that is debatable whether they can do that. They're not just flipping a coin or rolling a dice or something like that. But we have moved into a situation. The yield curve flipped and was inverted about a month ago in August of 2019. And what this means is that the return on the yield on short-term bonds is higher than the yield on long-term bonds, which means people don't really trust the economy in the long term. They want their money back quickly. And when this happens, generally speaking, the economy will go into recession within 1 to 2 years or thereabout. Back for the previous one, I think it was December of 2005 that that the yield curve inverted, and then the recession began. Late 2007, and then really got going in 2008. Unemployment is still great at the time of this recording. It's at 3.7%. The stock market is near all-time highs, although it's been flat for about 3 months, kind of up and down. Housing prices continue to go up. They have over the last, since about April, according to Zillow's sale data, since about April of this year, it's been more or less flat, but it hasn't gone down. And prices generally oscillate a little bit. Like they go a little bit up in the summer and a little bit down in the winter. So it's kind of like this, it's like that's how they'll go when they're going up, because people generally buy homes in the summer months and they generally don't sell in the winter months, especially in places like Kansas City, where we're at, where it's absolutely freezing cold. And the last thing you'd ever want to do is move. I mean, this is,
or live there. I mean,
I'm not sure Indianapolis is that different. I guess you're in San Diego now. That's an improvement. I was just looking at our MLS data. Kansas City is pretty similar. It's been flat since around May or around April of this year. But other than that, it's been growing steadily since the trough around 2009, 2010. Some other indicators: consumer confidence is down a bit. It's down from its high in early 2018 from 100.91. I don't even remember I don't know how they calculate this, but it's down to 100.08. So it's gone down a bit. Nothing crazy. Auto sales are down a bit. Again, the Fed just cut interest rates, and so we're looking. I think at this time, if I gazing into my crystal ball or my little magic 8 ball or whatever, I would say the economy will probably be flat for the next 12 months, and then probably start to go into a recession. I don't think it'll be a crash like last time, but you never know. Now, of course, this comes with a lot of grains of salt, but that is it. Especially given how long of an expansion we've had, the record all time. I don't think it's likely that we're going to continue this expansion for too much longer. I guess I'll open it up if anyone has anything else to add to that.
I think it's just uncharted territory. It's kind of hard what to expect when we're at a record. I imagine kind of my thought on it from the people I've been talking to. I kind of agree with your sentiment that I don't think it's really going to be a real estate crash. I think it's going to be more of a slowdown. I'd be more worried about subprime auto lending, student loans, that kind of stuff right now than I really am on the housing side. But I do think it also makes me glad that I'm in the market I'm in. I was out to dinner last night with some guys that used to invest heavily in Phoenix back in 2007. And that market, the bottom fell out of it. Prices dropped by over 70%. And they still say that in their mind, the market's foundation is ice, and ice always melts.
Which is a weird thing to say for Phoenix, where
they have PTSD.
Where it's so hot.
Phoenix is a roller coaster. It skyrocketed before the crash, just fell like a rock, and then it skyrocketed again afterwards.
Yeah, it's all based off of, supply and demand, and there's a lot of land, so they can keep building. It's just, I forget the data they were talking about, but something like 10,000 new homes are currently being built. So, I think it's, for those of us that are in markets that have industry and a lot going on, particularly in the Midwest, I'm a little bit, I wouldn't say I'm optimistic, but I'm not as freaked out as if, say, I was doing, luxury flips in Los Angeles right now.
I'd add 2 points to that. The first one is you may have heard that there's a major undersupply of housing, or that we still have a backlog of since development and construction pretty much ended during the crash. There's still a backlog. This is extremely there's still housing shortages. This is extremely market dependent in Manhattan, in San Francisco, in places like that. Yes, there's a massive housing shortage, but at the same time, this is not true, I'd say, in many other urban markets, especially more rural suburban areas. I wouldn't say there's a housing oversupply, but there is. I wouldn't say there's this major shortage that will save the real estate market. I'd also say that it doesn't completely matter, because if people are priced out, they're priced out no matter where things are at. So if they can't afford a house to buy it for that price, if they can't afford to rent it, then it's just the market will come down. And I agree with Ryan completely. I do not think this will be a real estate crash like 2008. That I think will probably be, it'll be the bond market, student loans, the car market, a combination of those things, maybe the stock market. But real estate will be pulled down with it. Like in the Great Depression, that was a stock market crash, but real estate was pulled down with it. So, which means it won't be hit real estate as hard as it did in 2008, even if it is a crash as big, but it will hit it nonetheless.
Just to look at a couple more macro features before we dive into the real estate market, there's a presidential election on the horizon, which makes a big difference. I'm sure the present administration will do everything in their power to not go into recession before that election happens. I have heard it.
I mean, there's only so much they can do, though. I mean,
yeah, absolutely.
Remember the last election, the last crash happened during an election.
The Trump administration can beat on the Fed continually till they have no more words to say to try to lower interest rates. It's just another factor. I think another outlier here is the fact that we have $1 trillion deficits every year now in good times, which is unheard of in U.S. economy. And deficits don't matter until they do. And we just don't know when they will matter. They haven't yet. But how in the world can we continue to rack up that kind of a negative balance sheet on the national, the national debt to think that that's not going to matter someday?
Not a business I'd want to own.
Yeah. The only thing keeping the United States in such a good situation, everybody else is so much worse off. That's really the bottom line. And we also can print dollars where other countries can't print their currency in the same way because the global economy trades in dollars. So we have a lot of things on our side, but that's just outliers. It's things we just can't control and don't know where we're going to happen.
You saying how thankful you are for the petrodollar? It does sort of tie us to Saudi Arabia, so it's not the greatest thing in the world. But
Bill and Andrew, last time going into it, were you eyes open? Like, we know we're in a recession, we're changing our business model, we're doing, I mean, a lot of our expansion happened, in the comeback from the recession. So it wasn't.
Well, you remember, Amanda, you were with us when we started flipping properties. And I think it was almost unconscious, but we realized that every month the value of properties was less than the month before. So we had to stop our buy and hold strategy, and we moved into more of a flipping strategy. And even that was difficult because as that recession gained so much traction, buyers had a hard time finding loans because lenders got so frozen up.
Well, and then I remember, I feel like it was around April 2010, the first time buyer home credit, which was like an $8,000 tax credit, was taken away. And that really just, it really it took the wind out of all of the sales that were left blowing. I mean,
we were doing a lot of short sales back then, and that happened the exact same time that the banks at one point were just giving them away. And short sales when the bank property is behind, a person is behind on their mortgage, but they haven't been foreclosed on, and then the bank allows them to sell the property for less than the principal of their mortgage. We were doing a lot of those. At one point, the bank was basically just giving them away, and then they just said, no, we'll take a small discount and nothing more. At the same time that the tax credit Amanda just mentioned was taken away, and it pretty much shut that. That's one of the reasons I'm out in the Midwest, actually.
Can you be more specific about that, Andrew, while you're in the Midwest?
Well, yeah, I mean, we wanted to get back into buy and hold. Flipping was very challenging. It's hard to do anything in a market that's going straight down. I mean, there's no, buy and hold. You need a massive discount because you got to make up for the fact that the property is going to be worth less next month in all likelihood. And flipping, there aren't very many buyers. It's easy to buy a property, but it's hard to resell it. So that is the most challenging investment market, is a market that's going straight down. But what follows that is the happiest market ever for real estate investors, one I'm quite nostalgic for, and that is the trough and up. And so we wanted to get back into buy and hold, and Oregon is a bit of an expensive market. It's certainly a market you can buy and hold in, but it's not ideal to. It's better for flipping. We were tired of flipping, even flipping in the good times before they took away our short sales. And so we took a trip out with a friend to the Midwest. A lot of our extended family, I mean, your parents are out here, a lot of aunts and uncles. And the prices were less, the rents were a little bit less, but not, the gap was much smaller between the two. And it just seemed to make a lot of sense. Cash flows a lot better in the Midwest and the Southeast and places like that than it does on the coasts. And so we just decided to pack up and start a branch out here. My brother Philip joined us a little while after that, and we were just started buying and holding ever since. And at that time, we could just pretty much just go out on these property tours and look at 15 different houses. Almost all of them were REOs, which is a bank-owned house, properties they've taken back after foreclosure. We'd make offers on 13 of them or so and get 2. And we just do that every month and go from there. I mean, financing was challenging. It was very hard to find any bank that would lend to us. But the properties were just being sold for very cheap. Nowadays, it's much easier to find financing, but you have to dig a lot harder to find the properties. Really probably have to do direct marketing, like mailing, text message, things like that, stuff we've covered in other podcasts. But that is really, that's really kind of where the market, that's kind of tracks the trends of the market. During the down cycle, it was very tough for us to do anything but flip, and that was challenging as well. But what comes after that is the best period for real estate investors there is, and that is the trough and up. And so in many ways, we personally would like I don't want to crash, and it's not a good thing to wish for a recession, but it would be helpful for our business. It'd be a lot easier to find properties to buy, and they'd cash flow a lot better. We do flip some. We are flipping more now because we're going into a rougher environment, market-wise. At least we think we are, and we're at the peak, and it's good to take advantage of those high sale prices. But buy and hold is where we really, that's where we butter that's our bread and butter. And so that's what we want to get back to.
Kind of when we did make that pivot into the Midwest and stopped the flipping, because, especially our model in Oregon was to try to acquire our houses via short sale in order to flip them. Well, a short sale can take 6 months to close. And by the time you purchase the property, you maybe don't even want to at that point because the value's gone down even further. And so we were just chasing that over and over. But what we had built up was private lender network, and we had, we knew bank and, commercial type lending was going to be hard to come by, but we had this private lender network built up that it made sense. Like, okay, well, maybe we can figure out, I don't know if we were that strategic about it, but it happened that way. Maybe we can figure out a different way to make this work for us. And, when we first were in Kansas City, our price point on a house was $15,000 or $20,000. Those are a lot of houses that we still own that didn't need, they needed some work, but we were still renting them for $600, $700, $800 a month. The numbers worked from a cash flow perspective, and we could afford to leave the private financing on them for the long term because the cash flow worked. It made sense. And so, I'd love to say like, oh, we were so eyes wide open, like this was the strategy, but it was sort of, I think we knew what we were doing, but it worked out better for us than we thought it would. Is that fair to say?
I think we should retcon the past and just say that this was all strategically.
Of course. But the key words that you said there, Amanda, was cash flow. And I think for any investors now looking into the future, as we are too, the one thing that will insulate you better than anything else is having healthy cash flow. And, so the people that got hurt obviously had bare land that wasn't returning anything, or commercial properties that were empty. Or they were flipping and had a lot of inventory on their hands. Those are the folks who got hurt the worst. We just happened to be cash flow investors. And again, it wasn't a huge strategy on our part to.
Well, let's say it was.
Well, it wasn't a strategy in the sense to make sure we were good in a recession, but what it did do is it allowed us to ride through the recession, because as long as there wasn't a tremendous recession in rents, a cash flow investor is all about rents. Can the property be rented at a reasonable rate? And yes, maybe the rents also drop a little bit during a recession. That's possible, but sometimes they don't. Sometimes they rise because people are abandoning their houses and they have to live somewhere. So, I think being a cash flow rich investor and having that as your mindset, we did deleverage during the recession. I remember selling places I probably didn't want to sell. Well, in retrospect, I didn't want to sell. And looking in any way I could to deleverage. But on the other side of that was just keeping the cash flow up and making sure our property management systems were in great shape, and filling our units with good people that could had reasonable job prospects and so forth. So in a total recession where people are losing their jobs, yes, even rents become an issue. But
we were also fortunate in that during that last recession, a lot of people left trades, went back to school, that sort of thing. And, college enrollment was up, and a lot of our Oregon portfolio is right around the University of Oregon campus. And we didn't feel a rent decrease during that period. In fact, it got a little bit tighter, and then everyone came in and started building, because that was one place that people could still build and make it work. And so still building, but we didn't feel that as much in our market. But that's not to say that other people wouldn't have felt it in other markets. We just didn't.
I would make a quick note, a little digression. Just every single one of our private lenders, when we asked them if they were interested in lending in Kansas City that we had that were lending in Oregon, every single one of them said no. And then every single one of them changed their mind shortly thereafter. So it's good. So I think we got every single one of them to lend to us in Kansas City that we had.
I can't think of one that said no. Yeah.
But they all said no at first, and then they all came back. So, don't be a pest, but kind of be a pest. No doesn't mean no forever. So, take the no and then maybe ask them again in a month or so.
Well, everybody saw the numbers when they were loaning $225,000 in Oregon, and they could loan $55,000 in Kansas City or Dallas, or one of our Midwest markets, and yet get the kind of rental return that they saw us getting. They felt much more comfortable of loaning money in the Midwest. And by the way, we usually borrow money between 7 and 9%. I would say 8 to 9% is more normal. But if you look at an amortized loan of 5% over 20 years, even though I'd prefer that loan because you're paying down the principal, the loan cost, the mortgage cost, is about what an interest-only 9% loan is. So if necessary, you can ride a long time on a private lender loan at somewhere around 9% interest only.
And our lenders are happy to let it happen.
Yeah, they'll ride as long. Yeah, we rode one for 10 years, right, on an 8-plex. And boy, was our lender tickled pink that we never pulled the trigger to refinance that thing.
Well, I think it makes a lot of sense too if they have confidence in you, if your private lenders have confidence in you, if that relationship's built. When there's blood in the water, they're not looking for another fish. It's kind of like, okay, my money's here. I'm getting paid. I'm good. That's not to say, I'm sure you guys can speak to it a little bit more, but I'd be curious if you guys had any people that just wanted more liquidity on hand that pulled back, or did you find that most of them wanted to keep getting the cash flow?
The only people that were concerned with liquidity, and we were in a different era of our business management at this point, were banks. And banks got to a point where, at one point, a bank sat down with a straight face and told us that if we parked our money, and I want to say it was like $800,000 or $1 million in the bank, and earned nothing on it, basically, they would feel comfortable loaning that same amount back to us at a percentage rate. I mean, and it was just
That's
like
a good deal.
no thanks.
Why would anybody ever do that? But apparently people
you want to
do.
pay us interest?
Do you
on
want a
like
secured credit
Own
card for
version
$1
of a
million?
secured? Yes, and it was like, maybe we look dumber than we are, but
I mean, I appreciate them having the honesty though. Like,
Well,
worst sales pitch ever, but
I think probably we should bring this back to sort of recession or peak market investing and just kind of give some whatever tips we have for investors out there who want to be careful, who want to invest in real estate but realize that this market is probably teetering on the brink of some sort of recession within the next 1 to 2 years. And I would start. First of all, I haven't read this book, but I'm very, very a big fan of the author, Jay Scott's book, Recession Proof Real Estate Investing. It is a book I intend to read. So I'd recommend, just based on the author, he has some very good books. His book on estimating rehab costs is I think a must read for real estate investors. So I'd recommend that to start with. And my position is just sort of, don't stop, but you need to do everything a bit more carefully. You need to, maybe if you're aiming for, one of the great things about the BRRRR model, the buy, rehab, rent, refinance, repeat, is that you're looking for a 25% equity margin to begin with. And that gives you a cushion in case the market goes down. And even if you don't have enough capital, let's say it goes down 10%, you don't have enough capital to refinance all of your money out and put a little bit in, you can still sell the property and make yourself whole. So I think you just need to be extra careful with your criteria, maybe even make it a little bit more conservative. Instead of aiming for if you're aiming for 80%, aim for 75, 70. You just be a little more careful on that, but also more especially really go through your due diligence. Make that, you should be making it a priority regardless, but really, really emphasize that, because this is not the time you want to get caught with a big capital expense you weren't expecting, and then the economy go into recession too. It's a double whammy. If you buy right, you should be okay. At least be made whole or very close. But it's one of those things you want to be. It's just more diligent at every step of the way.
Yeah, I think as somebody who's in kind of the direct to seller side, if I'm a turnkey buy and hold guy, I'd probably not be buying turnkeys right now, right? I'm not looking for deals with all the life sucked out of them. You want steak here, not beef jerky.
Probably not a great time for passive real estate investors, getting into syndications and things like that.
Syndications is another good thought. I think the other thing is, like, if you're going direct to seller, you can pivot with the market. So right now we're historically offering 75% of ARV minus repairs, minus what we hope to make. So if I've got a $100,000 house that needs $25K, I'm at $75,000 minus that $25K, minus either my holding costs to BRRRR that out, or if I'm flipping it, the profit I want to shoot for. The economy starts to go down, and I'm probably not going to stay at 75. I'm going to go to 70 or 65. I remember when I first started in real estate investing, and I'm the youngest one here when it comes to experience in the market. I haven't been through a recession, but I started right at the end of it. And I remember we were at 60, 65% of ARV was where we were starting with our offers. Now you go to a seller right now and offer them, 40 cents on the dollar. They'll kindly tell you where to go stick it. But I think it's really just about pivoting. Now is not a time I'd be buying for appreciation. Now is not a time where I'd be okay with the 1% rule. I want 1.25 or 1.5 if you can get it, right?
So I think what's that rule, Ryan? Exactly.
Rent to cost ratio. So a lot of people kind of recommend like a 1%. So if I've got a $100,000 house, want 1% of that in gross rent a month, so $1,000. In my experience, that doesn't cash flow super well, even at the 1% rule.
I would critique that rule in general, but we'll save that for another podcast.
Yeah, I mean, it needs to die a terrible death. And there's a lot more that goes into it than that. But at a minimum, we're looking for a 1.25 is kind of what we shoot for. So, and obviously, if you're in a market like a Southern California or a Phoenix or a market where that's a lot harder to do, you may just pivot. I've got a lot of friends that went through the crash that were fix and flippers that turned into wholesalers. I've got wholesalers I know that went the like short sale route or went more the realtor route. So I think it's just being aware of what's going on around you. And if you have, projects that you have concerns about, things where you're maybe trying to push the ARV on them, now is maybe a time to get your cash out and not, hold out for top dollar.
If we step back and look at the long term, if you see yourself as a long-term real estate investor, I'd encourage you to do what is called dollar cost averaging, at least mentally. So in the stock market, dollar cost averaging is where a stock investor puts in, say, $5,000 a quarter, and he or she's putting it into an index fund. And so they don't even care. Well, they care, but they can't control where the market's going because they believe in the long-term U.S. economy. So they're going to keep putting $5,000 in, whether it's high, whether it's medium, whether it's low. In real estate investment, I think there's something similar that you could think of over a 20-year period. And that is, I can't anticipate where the market's going to go. I really can't. This is a real quick thing. I have a friend who's a financial advisor who advised all his clients, because of the uncertainty of the market, to take all their money out when Trump won the presidency. Every bit of it. They went all to cash. And they missed a 40% upside. So you just can't, anticipate where the market's going to go, right? And that's true of the real estate market. So dollar cost averaging means that I buy wisely today. I buy wisely 3 months from now. I buy wisely 6 months from now, not thinking I know exactly where things are going to go. But if I buy wisely, the nice thing about the real estate market compared to the stock market is that I'm starting to pay down principal if I have a mortgage. I'm starting to, increase my equity position if I'm improving the property over time, if I'm raising rents and so forth. So I look back over, now I've been into it over 30 years, and say, boy, I'm sure glad I bought those properties 30 years ago, because those things, some of them have paid way down in their mortgage payments, or I've refinanced and gotten tax-free cash back to expand the operation, et cetera. So if you have a long-term view, I think dollar cost averaging, saying I can't anticipate the direction of the market, but what I'm going to do is buy wisely today and buy wisely again tomorrow, and then the next day as well. So I
think that's a great closing point of just like, if you get anything from this episode, buy wisely today based off the data you have today. Don't speculate. Don't fudge ARVs. Don't underestimate how much repairs you have. If you're buying good deals now that makes sense now, it's just you have to constantly be reevaluating what makes sense. But I think that's, I think that's the pinnacle of this episode of buy wisely today, buy wisely 5 years from now.
Remember that sage wisdom. And also, please join us at thegoodstewards.com. We have plenty of content there. We have free ebooks. And in addition to that, please subscribe to our podcast. Thank you again for joining us, and have a great day.